Good morning. I'm Scott Redler, Chief Strategic Officer with T3Live.com.
And I'm Alex Deal with The Street, and together we bring you the morning call. Scott, let's get to it. So S&P closing Monday above 1,200, above the level reached before that S&P downgrade. So as we see a sell-off today in the futures early Tuesday, how are you measuring that, and what is it telling you?
Well, I heard a lot of people on TV saying, oh, take back where we were, with the S&P downgrade. Everyone likes to focus on headlines, but the fact of the matter is we went from the highs of 1370 all the way down to 1100. Okay, that's a big move lower. We broke the neckline at 1250 down to 1100. So we snapped back for 3 days to about 1200. So that's a 1100 to 1200. That's a 100 handle move. We went about 1,000 points in the Dow. That's a normal snapback into what was a crazy, volatile scenario.
So is this a normal sell-off?
It could be, or it might be just back to the lows. So
how do you measure?
Retracement rules.
There you go.
There we go. Back to retracement rules. You'll hear us say different types of terminology over and over again because that's what technical analysis is, because patterns repeat themselves. So now what we want to do is we want to measure the commitment to that 1,000-point move in the Dow and that 100-handle move in the S&P. So what we do is we measure levels to see where we should hold in order to see if buying comes in. So if we take a look at the chart, let me show you here. This is a chart of the SPX. This was that head and shoulders pattern we went over so many times. This is when we broke the neckline. This is how we had the huge volume move all the way down to 1100. And here's your snapback from 1100 back to about 1200. This was the last area we watched when we broke above the lower pivot around 1165. So, Alex, what I want to show you right now is a feature that technical analysis uses is retracement rules with Fibonacci numbers.
Which I loved when you showed this to me before we started the show.
So I'll show you how I don't make this up in my head. So if you go back to the chart, you'll see here's your Fibonacci retracement. So what you do is you go from the low of that move all the way up to yesterday's high, okay, which is right there. So I'll move it over so you can see it. The 38.2% Fibonacci retracement is 1166. So the market should hold this area, which is also a retest of this broken lower pivot to the upside. If there's any commitment to this move, if you want to see any quick upside momentum, this level should hold. And if this level were to break, the line in the sand is the 50% retracement level, which is 1154.
All right, so then how are you trading? Because on Monday you were saying that you were lightly invested, but you weren't going to add to that. So then based on the Fibonacci rules, where would you be adding and strengthening your positions?
So I'm going to look at the spiders and see if they hold those levels. Last week when the futures opened lower, they were relentless and they closed on the lows. So we need to see if the composure changed. Can we open up down 15, 17 handles, stop at that area and pause, go sideways so we can continue again, or do we break through those areas, nothing goes green, and we go back to those lows? So that's what traders are going to be watching to see if there's a complexion change where we could hold higher in order to stay with this rally, or do we see a W back down to those lows so we get a retest to figure out if they're strong enough to hold.